FA1 Part A. Introduction to Transaction Accounting. Chapter 4. Completing Ledger Accounts and Financial Statements. The topics that this presentation will cover are 1. Balancing ledger accounts. 2. The trial balance. 3. The journal. 4. Errors. 5. Financial statements. 1. Once all transactions for an accounting period have been posted to the ledger accounts, the balances on each account can be calculated. These are the steps that are done to calculate the balance. Step 1. Calculate the totals for both sides, debit and credit, of each ledger account. Step 2. Deduct the lower total from the higher total. Step 3. Insert the result of Step 2 as the balance carried down on the side with the lower total. Step 4. Check that the totals on both sides are now the same. Step 5. Insert the amount of the balance carried down as the new balance brought down on the other side of the account. The new balance brought down is now the balance on the account. 2. A trial balance is a list of ledger accounts shown in debit and credit columns. The trial balance is prepared to check if the debit and credit are posted correctly. In a trial balance, the total of the debit and credit balances should equal. The following steps are taken in order to produce the trial balance. Step 1. Collect together the ledger accounts. Step 2. Balance the ledger accounts. Step 3. Collect the balances on the ledger accounts. If the basic principle of double entry has been correctly applied, then the balance of all credits will equal the balance of all debits. Once the balances of the ledger accounts have been collected, they are then put in a list. The order of the accounts in the list don't matter, because it is not a document that a business has to make, so there are no rules on how it needs to be made. The trial balance is made to check the accuracy of the double entry bookkeeping method. 3. The journal is used to record any unusual movements between accounts. It is also used to record any double entries made that don't appear in any other books of prime entry. To see an example of how a journal entry is laid out, see page 96 of your interactive text study guide. The journal is also used to correct errors in general ledger accounts. A narrative explanation must be with every journal entry. It is required for audit and control, and to show the purpose and authority of every transaction. Journal entries might not be made in a book or journal, but on separate slips of paper, which are called journal vouchers. 4. The trial balance will be able to show if there is an error in the recording of the transactions in the accounts, if the debits do not equal the credits, but the trial balance will not be able to show the following types of errors. Omission error, when a transaction is not recorded at all, or a credit is made but not the corresponding debit or vice versa. Commission error, when the bookkeeper makes a mistake in carrying out their task, by posting to the correct side, debit or credit, but posting the wrong amount or to the wrong account. Compensating error, when two errors are, coincidentally, equal and opposite, to each other. Transposition error, when digits of an amount gets swapped. For example, entering 49 instead of 94. Principal error, when the amounts are entered into an account, in a way that it breaks an accounting rule, principle, or concept. Once the errors have been found, they need to be corrected. If the error involves a double entry, then correct it with a journal entry. If the error breaks the rule of double entry, then correct it by entering it in the suspense account, until the error can be corrected with journal entries. The suspense account is a temporary account that is created for a number of reasons. These are the most common reasons. The trial balance doesn't balance. The bookkeeper knows where to post one side of the transaction, but doesn't know where to post the other side. For examples of the use of a suspense account, see page 100 to 101 of your interactive text study guide. Stop the lecture. Answer the questions on page 101 and 103 of your interactive text study guide. 5. Businesses produce financial statements to show how well they performed or their financial performance, over an accounting period, and to show their financial position at the end of a period. To determine the financial performance over a period of time, a business produces an income statement or a profit and loss account. This statement will show income, which is revenue earned and made mainly through the sales of goods or services. Expenditure, which are costs incurred to make income, for example, purchases, wages, utilities. When income exceeds expenditure, then the business has made a profit. At the end of an accounting period, a statement of financial position, or balance sheet, gives a snapshot of the business's financial situation. It shows the balances of the assets, liabilities, and capital of the business at one point in time. The key elements to a statement of financial position are assets, which are resources the business uses to make an income. Liabilities, which are amounts owed by the business. And capital, which is the owner's investment in the business and any accumulated profits. The following is a summary of the crucial elements of recording financial transactions. Business transactions are recorded on source documents. Source documents are recorded in the day books. Information in the day books are posted to the ledger accounts. At the end of a period, the ledger accounts need to be balanced. A trial balance can be drawn up to check for errors, and the correct posting of accounts. Once the accounts have been checked, and a trial balance drawn up, then the financial statements can be drawn up. This is the end of Chapter 4. What will now follow is the quick quiz. After the quick quiz, do the online questions for Part A, Chapter 4. It will be good practice because the online questions are set out like the exam that you do at the end of the course. They will also test your knowledge of this chapter. Quick quiz. Question 1. If the total debits in an account exceed the total credits, will there be a debit or credit balance on the account? Question 2. What is the other name for a list of account balances? Question 3. Why must a journal include a narrative explanation? Question 4. A journal can be used to correct errors which cause the total debits and credits to be unequal. True or false? Question 5. What types of error will not be discovered by drawing up a trial balance? Question 6. What is a statement of financial position? After doing the quick quiz, do the online questions for Part A, Chapter 4. Do the questions, until you achieve 80%. Replay the lecture as needed.